Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tonnage updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 10 a.m. and 6 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Something unusual is happening around XRP right now. Not just the price action, not just the pullback, but the structure underneath the market itself. While retail traders argue over whether XRP can realistically reach $100, institutions are quietly increasing exposure through regulated investment products. Lawmakers are rewriting parts of the regulatory framework, and global liquidity conditions are beginning to matter more than hype cycles. Let that sink in. At the same time, inflation is rising again. Markets are nervous, volatility is increasing, and uncertainty is everywhere. So the real question is no longer simply, can XRP, the anointed one, go higher? The real question is this: what kind of financial system would need to exist for something like that to happen, ladies and gentlemen? Because beneath the short-term noise, the system itself may be evolving. And today, we're breaking all of it down. Right now, XRP is experiencing a short-term pullback. At the time of this discussion, price is trading around the $1.37 area after falling roughly 4%. And on the surface, that may not sound dramatic. In crypto, moves like that happen constantly. But what matters is not the percentage itself. It's the environment the move is happening inside. Besides, and because this pullback is occurring during a period of rising macro uncertainty across global markets, inflation in the United States recently came in hotter than expected at 3.8%. And when inflation starts moving higher than forecasts, markets immediately begin recalculating risk. Interest rate expectations change. Liquidity expectations change. And investor behavior changes with it. Write that down. Now, this is what most people miss completely. Crypto does not move in isolation anymore. Years ago, the market was driven mostly by retail emotion and speculative momentum. Today, macroeconomics matters, liquidity matters, institutional positioning matters, and that changes everything. Because when inflation rises, central banks often become more cautious. And when central banks become cautious, liquidity can tighten. And that matters because liquidity is the fuel that powers risk assets. When liquidity expands, speculative markets often surge. When liquidity contracts, volatility increases and capital becomes more selective. That's why short-term pullbacks during uncertain macro conditions are not unusual. They're normal. Even strong markets experience periods of hesitation. And in crypto specifically, corrections of 3 to 10% happen regularly, even during broader uptrends. But here's where things get interesting and spicy. While short-term volatility has increased, institutional interest around XRP has not disappeared. In fact, recent spot XRP exchange-traded product flows suggest the opposite. One reported inflow day alone reached approximately 25.8 million. Now, compared to trillion-dollar traditional markets, that number may not sound enormous, but institutions rarely move all at once. That's not how professional capital behaves. Large investors scale in gradually. They test liquidity. They evaluate regulation. They monitor custody, infrastructure. They study market depth. And then over time, they increase exposure if conditions improve. That process is slow, quiet, methodical. And historically, major financial trends often begin that way. The public usually notices only after the move becomes obvious, but the positioning often starts much earlier. And this is where the conversation becomes more serious, because XRP's future is no longer just a retail speculation story. It becomes connected to broader structural questions involving regulation, tokenization, liquidity, systems, and institutional participation. One of the biggest variables in the entire equation is regulation, specifically the ongoing developments surrounding the Clarity Act discussions. Now, before people get overly excited, it's important to remain realistic. Nothing is finalized. Drafts evolve. Language changes. Political timelines shift constantly. Markets often react to expectations long before actual outcomes become law. But even so, institutions are paying attention because the updated drafts reportedly expand the framework around digital asset classification, oversight responsibilities, investor protections, stablecoin structure, and anti-fraud provisions. And whether people like regulation or not, large institutions require it. Banks, funds, asset managers, pension systems. They do not operate comfortably inside legal gray zones. They need definitions, predictability, compliance standards, and operational clarity. That's one reason why legislation matters so much, not because regulation automatically pushes price higher, but because regulation creates the infrastructure that allows larger pools of capital to participate. Think about it like building highways before economic expansion. Commerce does not scale efficiently without roads, and institutions do not scale participation efficiently without legal frameworks. That's the first historical analogy people should understand here. Regulation is not the final destination. It's the transport layer that allows the system to expand, and historically, infrastructure changes often reshape markets long before the public fully understands what's happening. Take the Bretton Woods system after World War II. That's our first real historic example. When the global financial system was reorganized in 1944, the most important shift wasn't immediate price movement. It was structural trust. The establishment of standardized money relationships created predictability across nations. That predictability encouraged capital flows, trade growth, and financial expansion for decades afterwards. The key lesson: markets expand more aggressively when systems become more trusted and structured. Right now, crypto is still in the process of building that structure, and that does not guarantee success, but it does explain why institutions are watching regulatory development so closely. Because uncertainty slows capital deployment. Clarity accelerates confidence. Now, this is where the XRP, the anointed $100 discussion enters the picture. And honestly, this is where emotion often starts overpowering analysis. Some investors hear extreme targets and immediately assume they're either guaranteed or impossible. But professional market participants think differently. They focus on conditions, probability, requirements, timeframes, not emotional absolutes. So let's approach this realistically. Could XRP theoretically reach extremely high valuations in some future scenario? In theory, yes. But theory and probability are not the same. For a move towards something like $100 to occur, the financial environment supporting the move would likely need to look dramatically different than from today. We would probably need massive institutional participation, global liquidity expansion, deep integration to tokenized financial infrastructure, strong multi-jurisdiction regulatory clarity, significant real-world adoption, and sustained demand exceeding available supply for long periods of time. Those are enormous conditions, not impossible conditions, but very large conditions. And importantly, they are long-term structural variables, not short-term catalysts, because price does not rise simply because people want it to. Demand must consistently overpower supply. And in financial markets, especially at large scales, that requires real capital, not just excitement. Now, this is what most people misunderstand about technical analysis. Charts can show potential structures. They can show compression, momentum, trend behavior. But technical indicators themselves are lagging tools. Moving averages react to price, crossovers react to price. Indicators confirm movement after it begins. Price action leads indicators, not the other way around. And this matters because many traders treat indicators as predictive systems rather than reaction systems. They're not crystal balls. They're not tools for interpreting probability. And probability can change quickly when macro conditions shift. That's why macroeconomic forces matter so much right now, ladies and gentlemen. Because even the strongest looking chart structures can fail if liquidity conditions deteriorate, if inflation remains elevated, if central banks stay restrictive, if geopolitical instability increases. Risk assets can remain under pressure longer than many expect. But here's where things become more nuanced. Markets move in cycles, always. Expansion, consolidation, expansion, consolidation, always. And XRP, the anointed one, currently appears to be operating inside a transactional structure. And XRP currently appears to be operating inside a transitional structure where consolidation still dominates, but larger catalysts are slowly developing beneath the surface. This is where the idea of compression becomes important. Compression simply means volatility contracts over time, price begins moving within tighter ranges, energy builds, pressure builds, and eventually the market searches for direction. But compression alone guarantees nothing. A coiled spring can release upward or downward. Direction still requires confirmation, and confirmation usually comes through volume. Volume is conviction, ladies and gentlemen. Write that down. Let that sink in. If price breaks resistance with strong participation and rising volume, the move becomes more credible. If price rises on weak volume, the breakout becomes less reliable. That distinction matters enormously because in today's environment, confirmation matters more than prediction. And this is where our second historical example becomes relevant. During the dot-com era of the late 1990s, massive excitement surrounded internet companies. Some valuations became irrational. Many companies disappeared entirely. But beneath the speculation, one thing turned out to be true. The internet itself fundamentally changed the system. The speculative bubble collapsed, but the infrastructure survived. And eventually, the companies building real utility became dominant global businesses. That historical lesson matters for crypto today because speculation and structural evolution cannot exist simultaneously. Short-term hype may come and go, but long-term infrastructure shifts can continue developing underneath the volatility, and institutions understand this distinction extremely well. That's one reason regulated investment vehicles matter. Spot ETFs, custody solutions, institutional-grade trading systems. These products are not designed primarily for emotional retail speculation. They're designed for structured capital allocation. And when capital enters through those systems, market behavior changes. Retail traders often react emotionally to headlines. Institutions tend to react systematically. They evaluate compliance, liquidity depth, risk-adjusted returns, legal exposure, operational efficiency, and sometimes institutions are not even making directional bets. They may hedge exposure, balance portfolios, rotate capital dynamically, use derivatives, or allocate gradually across multiple digital assets simultaneously. So institutional participation does not automatically guarantee explosive upward movement, but it does signal increasingly structural legitimacy. And this is where the conversation around tokenization becomes important, because many analysts believe the larger opportunity in digital assets may not simply be retail trading. It may involve the tokenization of real-world financial infrastructure itself, bonds, securities, settlement systems, cross-border liquidity mechanisms, digital asset rails. If systems like that expand over the next decade, assets positioned inside those ecosystems could benefit from increased utility and liquidity relevance. But again, these are long-term processes, not an overnight event. And this is where patience becomes a competitive advantage, because emotionally driven investors often struggle during consolidation phases. Nothing feels exciting. Price moves sideways. Volatility creates frustration. People begin chasing narratives emotionally. But professional investors understand something important. Consolidation is part of market structure. Markets need time to absorb supply, time to establish support, time to determine whether buyers or sellers are gaining control. And this is why risk management matters so much. Every bullish thesis has an invalidation point. Every structure can fail. Professional investors do not assume one guaranteed outcome. They prepare for multiple possibilities simultaneously. What happens if price breaks higher? What happens if it stays range-bound? What happens if macro conditions worsen? What happens if regulation stalls? These questions matter. Write this down. This is really important because surviving markets is more important than emotionally predicting them. And this is where the second historical analogy becomes useful. Liquidity behaves a lot like ocean tides. When the tide rises, nearly all boats move higher. When liquidity expands, risk assets often rally together. But when liquidity retreats, weaker structure becomes exposed. That's exactly why macro conditions matter so much right now, because even strong narratives can struggle in restrictive liquidity environments. And at the moment, markets are still trying to determine whether the next phase will involve tighter conditions or renewed expansion. Now, this is what many people are overlooking. Regulatory clarity itself is not a direct price catalyst. It's a structural enabler. That distinction is critical. Clear regulation creates conditions where large pools of capital may feel safer participating, but participation still depends on demand, liquidity, market confidence, on economic conditions, and those variables fluctuate constantly. That's why markets often react to headlines. A regulatory draft emerges, price spikes emotionally, then reality slows things down again, because implementation takes time. Adoption takes time. Institutional rotation takes time. And global financial systems move far slower than crypto Twitter narratives. But beneath the short-term noise, the structure continues evolving. That's the bigger picture. And this is why some analysts continue paying attention to XRP, the anointed one, despite volatility. Not because price is guaranteed to explode tomorrow, but because the asset sits at the intersection of several major structural conversations: digital payments, cross-border settlement, institutional tokenization, regulatory classification, and liquidity infrastructure. Now, whether XRP ultimately becomes deeply integrated into those systems remains uncertain. No serious analyst can guarantee that outcome, but the conversation itself is becoming increasingly institutional, and that shift matters, because the market today is fundamentally different from previous cycles. Years ago, crypto was dominated by retail speculation. Today, governments are involved, regulators are involved, asset managers are involved, ETF structures are involved, custody providers are involved. The ecosystem is maturing, messily, slowly, imperfectly. But it's also evolving, and price is reacting to that evolution in real time. Sometimes positively, sometimes negatively, but always dramatically. Now let's bring this back to the realistic outlook. If XRP remains below major resistance zones and macro uncertainty continues increasing, price could remain volatile and range-bound for some time. That is entirely possible. If liquidity tightens further, speculative assets across the market could face additional pressure. But if regulatory clarity improves, if institutional participation continues building gradually, if liquidity conditions eventually improve, then higher probability expansion scenarios begin opening over longer time frames. Notice the wording carefully. Higher probability, not certainty. Because serious investing is about managing probabilities, not chasing guarantees. And emotionally, that can be difficult for people. Human psychology naturally seeks certainty, especially during volatility and volatile markets. People want immediate answers, immediate timelines, immediate outcomes. But markets rarely operate that way. Instead, they evolve through phases: awareness, participation, expansion, correction, reaccumulation. And right now, XRP appears to be somewhere between consolidation and gradual institutional awareness. Not full-scale adoption, not complete transformation, but potentially early structural positioning. And this is why mindset matters more than most people realize. Emotional impatience destroys more portfolios than bad analysis. Boredom causing over trading, fear causing panic selling, euphoria causing reckless entries, leading to people getting cut up like sushi. Professional investors train themselves to stay structured during emotional environments. They wait for confirmation. They respect invalidation. They manage risk before chasing upside. And that mindset becomes especially important in crypto because volatility amplifies emotional constantly. One day markets look unstoppable. The next day fear dominates headlines. But beneath those emotional swings, larger systems continue developing quietly, slowly, incrementally. That's the real story unfolding right now. Not just XRP price movement, but the transformation of digital assets from speculative retail instruments into increasingly institutional financial structures. And whether people realize it or not, regulation sits at the center of that transformation. Because without legal clarity, institutions remain cautious. Within clearer frameworks, participation becomes easier. Not guaranteed, but easier. And if participation increases consistently over time, market dynamics can gradually change. Liquidity deepens. Volatility may stabilize. Infrastructure improves. Trust expands. And entirely new financial products can emerge. But again, that process unfolds over years, not overnight. Which brings us back to the $100 debate. Could extreme long-term targets become mathematically possible under extraordinary global conditions? Some analysts believe so. But the conditions would likely involve enormous capital inflows, widespread institutional integration, significant global adoption, favorable macro conditions, mature regulatory systems, and deeply connected tokenized financial infrastructure. Those are system-level developments, not meme cycle catalysts. And understanding that difference is critical because hype focuses only on price. Professionals focus on structure, short-term noise, long-term structure, like I always say. That's the mindset investors need in this environment because price is reacting, but the system itself is evolving. And whichever force eventually gains dominance, expansion or contraction, confidence or uncertainty, institutional acceleration or regulatory friction, price will ultimately reflect that balance. That's how markets work, not emotionally, structurally. And that is why the smartest approach right now is neither blind optimism nor blind pessimism. It's disciplined observation. Watch liquidity, watch regulation, watch institutional participation, watch confirmation. Let the market prove direction before becoming aggressive. Because in complex financial transitions like this, patience often becomes more valuable than prediction. At the end of the day, ladies and gentlemen, XRP is operating inside a much larger transformation than most people realize. This is no longer just about retail speculation. It's about institutional infrastructure, liquidity systems, regulatory frameworks, and the evolution of digital finance itself. Short-term volatility will continue. Pullbacks will happen. Headlines will create emotional reactions. But beneath all of that noise, the long-term structure is still developing. And that's the part serious investors are watching most closely because price is reacting, but the system is evolving. If you enjoyed this breakdown and you value structured analysis over emotional noise, make sure to subscribe and stay close to this channel. Never miss any of our updates. And let me know in the comments, do you believe XRP's future depends more on regulation or liquidity? Because over the next few years, that question may matter more than price targets itself. Well, ladies and gentlemen, I hope everyone's having a fantastic morning. I want to welcome all the new members of the Crypto Republic Desk Monthly and the Patreon, all the new members of our membership channel. I want to go over a couple things real fast today, and I'm going to go further on these subjects in our afternoon video. I'm always harping on certain things. I'm harping on nickel. We go over nickel in the tips and the pits. Nickel jumped as Indonesian output cut strokes supply fears. Nickel prices on the London Metal Exchange surged as much as 2.6% to 19,050 a ton after Shanghai metal markets said upwards of 15% of high-grade nickel pig iron capacity in Indonesia's Wida Bay Industrial Park will undergo rotational maintenance in the coming months. Indonesia dominates global nickel supply, producing 2.6 million metric tons of nickel in 2025 out of a global total of 3.9 million tons, accounting for roughly 2/3 of global mine production. Write that down. That's massive. So the news coming from the SMM indicating a 10 to 15% reduction in NPI output from Wida Bay Industrial Park in the coming months is massive. So if you take that, building on NPI reductions in March and April due to lower ore supplies and high costs has easily sparked supply concerns on the LME. Ladies and gentlemen, nickel is extremely valuable, and it's a critical industrial metal in the era of electrification, data center build-out. We're going to get to this. A lot of good free nuggets in this one. With their build-outs, you got stainless steel, by far the largest demand center, where nickel improves corrosion resistance, strength, and heat tolerance. EV and energy storage batteries, especially nickel-rich lithium-ion, chemistries that increase energy density and driving range. Aerospace and military alloys, including jet engine turbine blades and high-temperature gas turbines. And industrial alloys, plating, catalysts, used across machinery, chemicals, and corrosion-resistant equipment. Ladies and gentlemen, let's not forget that sulfuric acid prices have surged amid the Hormuz disruption. This disruption in industrial chemical is so rough because it's used in nickel leaching and production, especially in Indonesia battery-grade nickel supply chain. It's so big that everything is so intertwined together. It's all intertwined. It really, really is. There's not enough. And what I'm about to go over right now is big. Because listen, ladies and gentlemen, big tech companies are no longer just buying electricity from the grid. They're starting to secure the gas and power infrastructure directly from the AI data centers themselves. The biggest plays right now that we spend all our time on the phone talking to family offices, the families, sovereigns, the energy wars, AI data center billouts. I told you in a previous video, it's kilowatt war, right? Well, the U.S. and the West side of the tranche is doing something that we're involved with that we've been actively talking about for a long time, building AI data centers close to energy reserves. Again, the world is changing right now. This is what's paying attention to. See, the drama and the kabuki theater that we live in every day is designed for you to not pay attention to what's happening. That's why people get cut up like sushi every day. But as the remora and the financial mercenary, this is all that matters. Ladies and gentlemen, remember this. The world itself is changing. The wealth tide is going out. And the people that set sail right now, and they're in certain spaces, are going to take advantage and reap the benefits for some time to come. That's in crypto, ICP, XRP, HBAR, energy, metals. It's all combined. One tip from the pits, ladies and gentlemen, can pay for your entire year subscription. If you want to see the deeper macro research, do come and join the Crypto Republic Desk monthly and join over 550 active traders and investors who have decided to become financial mercenaries and take their own destiny to their own hand, who are seeing how to take advantage of the moves in metals, nickel, sulfuric acid, crypto, the whole narrative, what's happening. It's people that take their own destinies into their own hand that win. People are going to be shaken out in this market. There's no doubt in my mind, because they're not paying attention to what's happening. Again, people are more concerned with, oh my God, with red charts because they have no money management when they're not paying attention to what's happening right in front of them. Again, I want to discuss something that I feel is the most important right now. Putin just had his trip to China. They went over the whole North Sea route. Okay, they got a lot of things, but he wants an entire energy line, the power of Siberia too. Okay, you got something in the market right now called tight LNG, and we're going over 3 massive direct exposure stocks in tips from the pits inside the Crypto Hub Debt Monthly. So if you want to see that, come and join us, because it's raining with these situations as far as I'm concerned. And you got to understand something. Russia's oil revenue spiked 39% in a single month. The Iran war is paying for the Ukraine war. Russia's oil and gas revenue are set to hit 700 billion rubles, 9.8 billion. In May, it's up 39% year over year. The reason, ladies and gentlemen, the U.S.-Israeli war in Iran, which started in late February, sent global oil prices higher. Russia's the world's third largest oil exporter. It's captured that windfall. So if you look at May's up 39% year over year, but down 17% month over month due to cyclical profit-based tax payments. So from January to May, revenues are still down a third year over year at 3 trillion rubles. Higher refinery subsidies, which is crazy, are eating into the budget gain. But if you look at the 2025 full year oil and gas revenue, that was the lowest since 2020. The Iran rally really helped them, but it hasn't reversed the structural pressure on Russian finances. The Kremlin's 2026 budget targets are 8.92 trillion rubles in oil and gas. That's 22% of total projected income, ladies and gentlemen. It's so huge, massive. That target was set before the Razan refinery was knocked out offline before Ukraine's drone campaign escalated further. One conflict is funding another, ladies and gentlemen. Write that down. One conflict is funding another. The Iran war lifted oil prices. Higher oil prices replenished the same budget financing Russia's military in Ukraine. That's the geopolitical feedback loop nobody wants to say out loud, ladies and gentlemen. If you're still here with me, understand that the wars and the conflict are feeding each other. I look at today's world, and I was just talking to somebody on the phone. That's why this video didn't come out at 10 o'clock. Do you realize that the modern day land grab for assets is in blockchain cryptocurrency? I've been a financial mercenary more than half my life. I've been taking things out of some of the most austere terrain in jungles that people can't even find on maps for half my life. It's amazing to see this. And from my vantage point, like I said, I'm a financial mercenary. I was built for this. I was bred for this. This is all I pay attention to. That's why if you're still here at this video and you wrote this down and you're paying attention to all this, it's raining. It's raining alpha. But this is where the Gucci conviction and the Gucci clarity comes through. It's because we're the remora. We don't get cut up like sushi. It's all over the place what's happening right now. Everything else is kabuki theater. Nobody's paying attention to this because it sounds boring. But you know what's exciting? Seeing green go into your bank account. Putin's in Beijing, ladies and gentlemen, for a 2-week summit. 2-day summit. He's talking about the power of Siberia 2, the 50 billion cubic meter per year pipeline that he's been chasing for years. The summit's delivered a lot of words and a handful of headline numbers, bilateral trade, blah, 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 nearing 240 billion in 2025. 99% of that's settled in rubles. Xi's calling the world far from calm. It's unpredictable. It's chaos. Because it is chaos right now, ladies and gentlemen. But if you look at how much energy is settled in rubles and yuan, it's pretty crazy. You understand me? But he wants the Siberia 2. He wants it. So if you look the same week, the U.S. LNG exporters, they went to Brussels with a different ask, a regulatory timeout. They're saying, please delay the enforcement of the new methane rules on imports until at least 2028. They said because the uncertainty is already freezing long-term contracts exactly when buyers need to refill a market hit by Hormuz disruption, a multi-year outage in Qatar. Two of the world's biggest gas sellers asked their buyers for accommodations 48 hours. In Beijing, Putin is a political language. The headline trade numbers, the currency win, and the energy supply handshake, but no signed POS2 price. In Amsterdam, the U.S. LNG exporters got no answer at all. And a market everyone's calling tight because Iran closed Qatar's LNG capacity for 3 to 5 years. I told you that Iran created the golden passage for the United States, LNG. It's raining these trades. They're all connected. AI centers, energy, LNG, write all this down. It's raining. This is the future right now. That's the opposite of what textbook seller power lecture like. So we're going to go over 3 direct exposure positions that we go over in our portfolio and the tips and the bits that are going to benefit from this. If you want to see access to this, come and join the Crypto Republic Desk monthly, ladies and gentlemen. Ladies and gentlemen, there's so much happening and changing in the world right now. And if you made it to the end of this video, I appreciate you. We're going to have videos every morning at 10 a.m. and in the afternoon between 4 and 6. We're trying to get the perfect time. Right now, the world is changing. You have to have conviction and clarity right now. Conviction and clarity are going to take you to wait. When I harp on things on this channel, and I love being here with everybody, why I say we're the remora, we're under the apex predator doing what they do. This was drilled into my head in the fall of the New York Mercantile Exchange. All right? I love talking to everybody in the Patreon, going over this with them. I love teaching everybody this, and so does Domenico and AJ, because when you see how this all plays into each other, you begin to follow the themes that we're talking about like a soap opera. Instead of characters, you got financial instruments. And each financial instrument we go over has got its own psychotic story of chaos. But what we're also going to go over is we're going to go over predictability, because that seems to be where everyone's going right now. The predictability markets and prediction markets. We're going to be entering into that in our tips and the pits. But understand this. Everything's intertwined. The chaos is here is on purpose. I love everybody. If you're tired of watching from the sidelines and you want to understand how to capitalize off the chaos, come and join the Crypto Republic Desk monthly. That's all you got to do. I love you all. I'll see you this afternoon. Make sure you subscribe to the channel if you're still here, because you're going to want to see what we go through. This content is for informational and entertainment purposes only. It should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never let it happen again, or you could be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. You move now will be remembered. This is not the end of the story. This is just the beginning. This has opened your eyes. Smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. See you on the front lines.